On January 26, 2026, the global geopolitical and economic architecture, largely static since the end of the Cold War, experienced a series of structural fractures that historians may arguably classify as the terminal onset of a multipolar disorder. The events of this single day, spanning the icy straits of Greenland, the trading floors of Mumbai, the diplomatic corridors of Davos, and the digital ledgers of the blockchain, represent a convergence of long-standing systemic stresses into acute kinetic and financial crises. This report serves as the foundational daily deep dive analysis, dissecting the winter of the Middle Powers. It moves beyond the superficial headlines of missed phone calls and tariff threats to expose the underlying tectonic shifts. The operationalization of non-dollar energy trade by the world's largest democracy, the physical fragmentation of the NATO alliance over Arctic sovereignty, and the market's violent repricing of safety as gold breaches the $5,000 barrier. The analysis contained herein is exhaustive, leveraging intelligence from diplomatic cables, market data, and strategic risk assessments to provide a granular view of the world on this pivotal Monday. It operates on the premise that volatility is no longer a cyclical anomaly, but a structural feature of the emerging international system. The geopolitical layer, the death of Atlanticism, and the Arctic front. The most visceral shock to the global order on January 26, 2026, emanated from the World Economic Forum in Davos, where the polite fiction of Western unity finally collapsed under the weight of American expansionism and European intransigence. The trigger was not trade in the abstract, but territory in the concrete. The island of Greenland. The Greenland crisis, from real estate to existential threat. For decades, the North Atlantic Treaty Organization, NATO, relied on the assumption that territorial disputes occurred outside the alliance. On January 26th, that assumption was obliterated. The crisis, brewing since late 2025, reached a crescendo when U.S. President Donald Trump, addressing the Davos Forum via video conference, explicitly linked economic warfare to territorial acquisition. The U.S. strategic calculus. The American position, articulated with characteristic bluntness, frames Greenland not merely as a resource-rich territory, but as the essential northern anchor of hemispheric defense. The administration argues that the GI-UK gap, Greenland, Iceland, UK, is the only viable choke point to contain Russian naval projection and emerging Chinese Arctic ambitions. With melting ice caps opening new commercial and military lanes, Washington views Danish sovereignty, which it characterizes as unable to defend the territory, as a security liability. The president's rhetoric at Davos was uncompromising. We want a piece of ice for world protection, and they won't give it. We've never asked for anything else. So they have a choice. You can say yes, or you can say no, and we will remember. This statement marks the transition of the dispute from a transactional proposal, purchasing the island, to a coercive ultimatum. The economic weaponization, targeted tariffs. Moving beyond rhetoric, the U.S. administration operationalized its dissatisfaction through the weaponization of trade policy. On January 26, the threat of punitive tariffs on specific European nations crystallized into a formal policy roadmap. The administration announced a 10% tariff on imports from 8 NATO allies: Denmark, the United Kingdom, Finland, France, Germany, the Netherlands, Norway, and Sweden. These tariffs are scheduled to take effect on February 1st, 2026. Crucially, the policy includes an escalator clause. If a deal for the complete and total purchase of Greenland is not reached by June 1, 2026, the tariffs will rise to 25%. This linkage of trade penalties to sovereign territorial concessions is unprecedented in modern intra-Western diplomacy. It effectively holds the export economies of Northern Europe hostage to the territorial integrity of the Danish realm. The European response. Operation Arctic Endurance. Europe's reaction has shifted from incredulity to active resistance. Under the informal leadership of French President Emmanuel Macron, European nations initiated Operation Arctic Endurance. This military maneuver involves the deployment of soldiers, naval vessels, and aircraft from the targeted nations to Greenland. While officially described as a reconnaissance mission and a joint military exercise, the strategic signal is unambiguous. Europe is physically garrisoning Greenland to deter a forced annexation or a unilateral U.S. security takeover. The presence of European troops on Greenlandic soil, ostensibly to protect it from their own NATO ally, creates a tripwire force. It raises the specter of a kinetic clash between U.S. forces, should they attempt to enforce a blockade or landing, and European defenders, a scenario that would render Article 5 of the North Atlantic Treaty null and void. The diplomatic rupture at Davos. The Davos summit, usually a venue for globalist consensus, became the stage for this rupture. The atmosphere was described as the winter of the middle powers, a realization that the rules-based order protecting mid-sized states like Denmark has evaporated. Emmanuel Macron's rebuke. The French president, wearing sunglasses due to a medical eye condition, delivered a stinging critique of the U.S. position. He labeled the tariffs useless aggressivity and new colonialism, framing the conflict as a choice between rule of law and brutality. Ursula von der Leyen's stand. The European Commission president questioned the trustworthiness of the U.S. president, noting that a deal is a deal, and characterizing the tariffs as a betrayal of the trade truce agreed upon in July 2025. The climb down on force. In a critical moment of de-escalation, following a meeting with NATO Secretary General Mark Rutte, President Trump publicly stated, "I won't use force," acknowledging that while the U.S. could be unstoppable militarily, it would seek to achieve its goals through negotiation and economic pressure instead. This removed the immediate threat of invasion, but entrenched the economic siege. Implications for the Atlantic Alliance. The events of January 26, 2026, signify the functional end of the Atlantic Alliance as a value-based community. It has reverted to a transactional security arrangement where coercion is a standard tool of negotiation. The invocation of the Anti-Coercion Instrument, ACI, by the EU, a trade bazooka allowing Brussels to restrict U.S. investment and service providers, is now being actively discussed. If triggered, this would create an economic iron curtain down the middle of the Atlantic, separating the U.S. NAFTA bloc from the European single market. The economic layer, the Petro-Rupee, and the silent financial war. While the Atlantic crisis captured the cameras, a far more dangerous threat to American hegemony was unfolding in the Indo-Pacific. The stalling of the U.S.-India trade deal on January 26th was publicly attributed to a trivial diplomatic faux pas, a missed call. But in reality, it marks the opening salvo of a financial war over the currency of energy. The missed call deception. Commerce Secretary Howard Lutnick's announcement that the trade deal stalled because Prime Minister Narendra Modi did not call President Trump is a diplomatic fiction designed to mask a fundamental strategic divergence. In the high-stakes world of statecraft, leaders do not miss calls on landmark trade deals. They decline them to signal a shift in alignment. The true cause of the rift is India's quiet operationalization of the Petro-Rupee mechanism, the mechanism of de-dollarization. For 50 years, the petrodollar system, anchored by the 1974 U.S.-Saudi Pact, required oil to be priced and settled in U.S. dollars, USD. This created artificial demand for the dollar and allowed the U.S. to export its inflation. On January 26th, intelligence surfaced confirming that New Delhi has engineered a regulatory and financial framework to bypass this system entirely. Objective: to purchase crude oil using the Indian rupee, thereby insulating the Indian economy from U.S. monetary policy and sanctions risk. Implementation: the mechanism utilizes Vostro accounts, accounts held by foreign banks in Indian domestic banks, to settle payments. Oil exporters accept INR, which they then use to invest in Indian government bonds or purchase Indian goods/services. The U.S. reaction? The U.S. views this not as a trade dispute, but as a violation of a red line. The ability to buy energy without dollars undermines the exorbitant privilege of the U.S. currency. The stalling of the trade deal is the first punitive measure in retaliation for this structural defiance. The BRICS Bridge, institutionalizing the split. The Petro-Rupee is not an isolated experiment. It is the pilot program for a broader architecture known as the BRICS Bridge. Reports on January 26th confirmed that the Reserve Bank of India, RBI, has recommended placing the interconnection of central bank digital currencies, CBDCs, on the agenda for the upcoming 2026 BRICS Summit. Technical foundation? This system builds on the mBridge project, involving China, Thailand, UAE, Hong Kong, which utilizes a multi-CBDC platform to facilitate real-time, peer-to-peer cross-border payments without relying on the SWIFT messaging system or correspondent banks in New York. Strategic impact? A functional BRICS bridge allows the global majority, BRICS Plus nations, to conduct trade, settle energy contracts, and move capital completely outside the visibility and jurisdiction of the U.S. Treasury's Office of Foreign Assets Control, OFAC. The anti-American label? The Trump administration has explicitly labeled the BRICS alliance as anti-American and threatened 100% tariffs on member nations that participate in de-dollarization schemes. This sets the stage for a currency Cold War, where utilizing a non-dollar settlement mechanism is treated as an act of economic hostility. The market reaction, the flight to hard assets. The convergence of the Greenland crisis, geopolitical instability, and the Petro-Rupee revelation, monetary instability, triggered a violent repricing of risk assets on January 26, 2026. The market sentiment can be characterized as a frantic search for sovereign-grade safety that is immune to political debasement. Gold, the $5,000 breach. The most significant market signal of the day was the historic performance of gold. Price action? Spot gold prices surged 1.8%, breaking the psychological barrier of $5,000 per ounce to reach a record high of $5,078. The Trump turmoil premium? Analysts attribute this surge to a loss of faith in the U.S. political system's stability. The chaotic policies and proclamations regarding Greenland, combined with the threat of a government shutdown over DHS funding, have driven investors into the ultimate safe haven, the debasement trade. Beyond fear, there is a rational calculation regarding currency value. With the administration signaling a desire for a weaker dollar to boost manufacturing, and the Federal Reserve reportedly checking exchange rates, a precursor to intervention, the market is front-running a deliberate devaluation of the greenback. Historical context. Market veterans are comparing this move to the late 1970s, early 1980s inflation scare. The 90% rise in gold since the 2025 inauguration suggests a systemic loss of confidence in fiat currency regimes, not just a tactical trade. Equities. The Sell America rotation. U.S. equity markets, represented by the S&P 500 and NASDAQ, faced significant headwinds, caught between the deflationary shock of potential trade wars and the inflationary pressure of tariffs. Volatility. The S&P 500 futures displayed erratic behavior, trading in a volatile range with significant downside gaps, hovering near the 6,100 level, with some technical resistance noted at 6,900 in other contracts, indicating severe market dislocation. Technology. Bearish. The Magnificent Seven and semiconductor stocks faced heavy selling. Intel, INTC, sank 17% after issuing a soft outlook, dragging the NASDAQ down. The tech sector is particularly vulnerable to the European trade war, as tariffs on digital services and hardware are likely retaliation targets. Defense and energy. Bullish. Conversely, sectors linked to kinetic conflict and real assets outperformed. With Operation Arctic Endurance active and a U.S. naval armada heading to the Persian Gulf, defense contractors saw inflows. Asian contagion. Asian markets mostly dipped, with the Japanese yen rising against the dollar. This yen strength is problematic for the carry trade, further tightening global liquidity conditions. Note that Indian markets were closed for Republic Day, delaying their reaction to the trade deal collapse until January 27th. The bond market paradox. U.S. Treasuries exhibited a counterintuitive move. Typically, geopolitical panic drives yields down as prices rise. Yields. The 10-year Treasury yield eased only slightly to 4.21%, a drop of 0.02%. Analysis? This muted reaction suggests a buyer's strike. While there is a flight to safety, investors are wary of buying U.S. debt when the issuer, the U.S. government, is actively threatening the global trade order that funds that debt. The fear of higher inflation from 10 to 25% tariffs is putting a floor under yields, preventing them from falling significantly despite the chaos. Cryptocurrencies. The Sell America drag. Bitcoin, BTC, often touted as digital gold, failed to capitalize on the chaos in the same way as physical gold. Price action. Bitcoin slipped to the $91,000 mark, trading sideways to down while gold rallied. The correlation trap. Because the Trump administration positioned itself as pro-crypto, crypto capital of the world, Bitcoin has become correlated with U.S. Inc. As global investors engage in a Sell America trade due to the tariff threats, Bitcoin is suffering collateral damage. Regulatory uncertainty. The rise of the BRICS Bridge, CBDC, also presents a competitive threat. If the Global South adopts a state-backed digital currency network, the use case for private, decentralized crypto in cross-border trade may be squeezed. Peripheral risk layers. Weather, AI, and the Gulf. While the primary crises raged in the Atlantic and Indo-Pacific, secondary risk layers contributed to the general sense of global disorder on January 26th. The domestic front, extreme weather. The United States itself is physically besieged by an extreme winter storm impacting 2/3 of the country. Freezing rain, ice, and dangerously low temperatures stretch from New Mexico to the northeast, causing catastrophic power outages in southern states and canceling thousands of flights. This domestic paralysis compounds the sense of institutional fragility as the government struggles to manage basic infrastructure while pursuing aggressive foreign expansion. The Middle East, the Armada to the Gulf. Tensions with Iran have re-escalated to critical levels. Following the suppression of U.S.-backed protests in Tehran, the Pentagon has ordered a massive naval deployment, a carrier strike group and air assets to the Persian Gulf. President Trump referred to this force as an armada. Risk. This deployment places U.S. and Iranian forces in close proximity during a period of high tension. With Israel already conducting operations in Syria and maintaining a buffer zone in Gaza, the risk of an accidental escalation that closes the Strait of Hormuz is elevated. This geopolitical risk premium is supporting oil prices, $66.22 per barrel, despite the demand destruction fears from the trade war, the AI tsunami, and labor disruption. At Davos, the discourse shifted from celebration of innovation to fear of disruption. IMF Managing Director Kristalina Georgieva warned of an AI tsunami hitting the labor market, predicting that 60% of jobs in advanced economies will be affected. BlackRock CEO Larry Fink echoed this, noting that the technological change is real and disarming. Insight. This technological anxiety feeds the geopolitical fire. As AI threatens middle-class jobs, governments are under immense pressure to protect domestic industries. This makes tariffs and protectionism politically popular, even if they are economically destructive. The tech nationalism driving the US-China and US-EU splits is fueled by the desperate need to secure the economic gains of AI within national borders. Future implications. The year of living dangerously. The events of January 26, 2026 set the trajectory for a year of profound instability. The winter of the middle powers will likely thaw into a spring of radical realignment. The end of exorbitant privilege. The combination of the Petro-Rupee, the BRICS bridge, and the weaponization of the dollar against allies will accelerate de-dollarization. We are witnessing the end of the Triffin dilemma's stable phase. The world is moving toward a multi-currency reserve system. Investors should expect the US dollar to lose significant purchasing power against hard assets, gold, land, commodities, over the medium term. The fragmentation of the West. The Atlantic Alliance is no longer a monolith. The activation of European defense mechanisms, Operation Arctic Endurance, and Economic Retaliations, ACI, suggests a future where the EU and US are competitors, perhaps even adversaries, in trade and regulation. The West, as a unified geopolitical entity, is effectively dead. Strategic portfolio allocation. For the individual investor, the playbook has changed. Long volatility. Markets are no longer pricing in a great moderation. Long hard assets. Gold's breach of $5,000 is a signal, not a top. It is the only asset with no counterparty risk in a world where every counterparty, including the US Treasury, is politically compromised. Caution on tech. The sector is caught in the crossfire of trade wars and regulatory crackdowns. Watch India. As the pivot state of the 21st century, India's successful defiance of the dollar regime will embolden others. The Indian economy, despite short-term volatility, is positioning itself as the independent third pole of the global system.